The previous part of the lecture covered some concepts dealing with demand. And the new idea, I guess, that we saw there was the idea of marginal revenue. How much extra revenue does the firm get if it lowers its price and sells one more unit of its product? Well, what we're going to do now is think about the cost side of things, and then we can put the information about revenues and the information about costs together to say something about profits. So let's explore the basic concepts that we'll need in thinking about costs. What I'm going to do is just go through a simple numerical example, hopefully a rather realistic one, where we're just going to be thinking about a publisher that's thinking about publishing a book. And if so, how much that would cost and what the consequences of that would be. I want to divide up costs into different categories. So one category of costs we're going to call fixed. So the definition of fixed costs is that the amount that the firm pays doesn't depend on how much it produces. In this case, the number of books that it publishes. So I'd invite you to just pause this video for a moment and think if you can come up with some examples of costs like that. Well, things that occur to me are things like the cost of office space. Perhaps the firm has to pay some rent. The firm may have a contract cost with the authors. So some people get paid what's called an advance before they publish a book. So the publisher has guaranteed them a certain amount no matter how much is sold. If you want to publish a book, you've got to edit the book, you have to prepare it for publication. So those are costs that really don't depend on how many copies are produced. Well, the other kind of costs that we're going to identify are called variable costs. So obviously, those are costs that vary with the amount that's produced. In this case, the number of copies that will be printed. Well, let's just summarize some cost concepts. We can just talk about total costs as just the sum of fixed and variable costs. Sometimes it's useful to talk about the average cost of producing the product. So there, we're just going to take total costs and divide it by the amount that is produced over a particular period of time. So kind of lying in the background here is the idea that we're spending a certain amount, say per month or per year, and we're comparing that to the total production over that same period of time. It's useful to have average cost because we can then compare it with the price and quickly get a sense of whether we're covering our costs or not. So if the price is greater than average cost, obviously we are making some money, we're making a profit. If price is less than average cost, then we're not covering our full costs. Although, as we will perhaps see later, we might still want to produce even though we're making a loss. Well, we can sometimes find it useful to break average costs down into its separate parts. So we can talk about average fixed costs and average variable costs. Well, let's turn now to consider a simple numerical example. You might just want to pause the video and look at this for a moment and see if you can make sense of it. Then I will just slowly walk us through the table. All right, well, you can see what I've done is just to organize things so that we have total production here on the left-hand side, and I've just assigned a particular value for fixed costs. So even if we don't end up printing any books, just to prepare the book has cost us $5,000. If we don't print any books, well, then there's no variable cost. There's no cost for paper and ink and all that stuff. But if we produce 1,000 copies, I'm going to suppose that that costs us $10,000. Now, a very useful concept is this concept of marginal cost. So marginal cost is just defined as the cost that the firm has to incur if it's going to produce one extra unit of output. So in this case it's $10, and you can see that because to produce the first 1,000 copies of this book has cost us $10,000. So that's a cost of $10 per book. Now, I've constructed this example so that if we want to produce another 1,000 copies, that adds another $10,000 to our cost. Well, you can easily see that that means that the marginal cost of each book remains constant at $10. If we add the fixed and variable costs together, we get our total cost. And you can see how that is increasing the more we produce. But the only reason it's increasing is because variable costs are going up. Well, lastly, we can calculate the average cost of producing a book. So we will just take the total cost and divide that by the number of books printed. Obviously, you can't divide by 0 and get any kind of sensible number, so that is undefined. But once we print 1,000 books, the total cost is $15,000, so it's cost us an average of $15 a book. And you can see that the more books we print, the lower is the average cost. That's happening, of course, not because the cost of producing an additional book is going down. We've seen that that's constant at $10. But obviously what's happening is that the fixed cost is now being divided by a larger and larger number of books printed. So if you go back to the previous slide and you just look at the definition of average fixed cost, that's just fixed cost divided by the quantity produced. So that number is getting smaller and smaller. So just to give an example here, average costs are $15. That's the sum of the marginal cost of $10 plus the average fixed cost, in this case, $5 per book. And as the average fixed cost gets smaller and smaller, the average cost per book starts to approach marginal cost. Okay. I just want to mention that this story that I've told about costs is different from the story that's in the textbook. So I'll just make a brief comment about that. In the text, marginal costs are rising. The claim that the textbook makes is that it eventually costs more and more to produce an additional unit of the firm's product. However, it's important to recognize that marginal costs are not determined by economic theory. It depends on the actual situation on the ground, depends on how costs actually change for a particular product. So I could call that an empirical question. It's a question of measurement, a question of fact. I could just add that economists have done surveys of businesses. They've gone and asked managers how their costs behave as they produce more and more of a product. And the response has been very often that marginal costs are constant. And in very few cases do marginal costs actually increase. So the story that I'm telling in the numerical examples, and that I'm going to continue to use through the course, is actually not only simpler than the story that's in the text, but it's actually, I think, more accurate, a better description of what's actually happening in the world. A final comment then. You can read the account of costs that are in the text and the rather elaborate story that surrounds it, but I don't think it's really important to pay too much attention to it. I would urge you to just adopt the simple constant marginal cost story that I'm going to use in the lectures, and in fact that is used quite frequently later in the text.